So welcome to this week's video, and what I'd like to do this time around is take a look at a security that's favoured by one of the world's most famous investors, Warren Buffett. Anyone who's been following his recent deals, the Heinz takeover for example, Goldman Sachs, Bank of America, will know that he likes a preference share. He buys billions of dollars worth of them. So what are preference shares? Why does he like them? Why would you like them? And would I recommend that you buy them? Okay. Well, let's take those in sequence. First of all, what are preference shares? The way to see a preference share, or a pref, as they're often called in the market, is as sort of midway between a bond and a normal share. So they behave a bit like a bond, but they are technically shares. So they kind of sit in a grey area in between the two. So let's take a look at one or two features. What would make a preference share different, say, to a normal share that you buy in a company on the open market through a stockbroker? Okay, so features of a preference share. Couple of quick ones. You get a fixed divvy. All right, unlike an ordinary share, where basically the dividend you get is decided by the directors and can vary quite a bit, with a preference share you get a fixed dividend. That's where it's like a bond. So Warren Buffett has been buying preference shares with coupon rates, as they're known, somewhere between 6 and 9%. So you do buy these things for income typically, and although it's called a coupon rate on a preference share, it is a dividend that you're getting. Okay, so it sounds like you're buying a bond, but you're actually buying equity. And that fixed dividend accumulates normally. What that means is that legally the company has to pay you your dividend as a preference shareholder before it can pay ordinary shareholders their dividend. All right? So there's one feature, and that's good in the sense that you know what you're going to get. It's a fixed income, and people do buy these things for income, and that income ranks slightly higher than those people waiting for an ordinary dividend, so that's good news. But of course it means you're not going to get a bumper payout. Okay? You're not going to suddenly see your dividend double because it's fixed. Right? And that tends to mean you get quite a bit of price stability with preference shares. Now, whether that's a good thing or not depends a little bit on your preference. Right? Because they pay a fixed dividend, a bit like a bond, they don't tend to be that volatile. In the wipeout of a few years ago, 2008, there's an exchange-traded fund that tracks preference shares in the US, and it only fell about 2/3 of the amount of the wider index. Okay? So they are more price stable, and that's a good thing insofar as it makes them a bit more predictable than maybe ordinary shares. Okay, less chance of a wipeout, but of course less chance of a big kicker capital gain as well. So sort of swings and roundabouts, but a lot of people buy them for income and they like the price stability. That's certainly two things that Buffett tends to like preference shares for. So what else we got? Well, technically, as a preference share, the word preference is a clue. It ranks above ordinary shares, I'll call them ords, in two ways. Number one, the dividend has to be paid first, as I mentioned. And number two, if a company goes bust, strictly speaking, preference shareholders have to be paid their capital back before ordinary shareholders. Okay, so that's just a little technical point there, but it's worth bearing in mind. Now, there are some drawbacks, I suppose you could see them as, to holding preference shares. Normally, you don't get voting rights. So an ordinary shareholder would normally be able to turn up at an annual general meeting and vote on key matters that affect the company, okay, like replacing directors and so on. Preference shareholders usually, it's always an exception that proves the rule, but usually don't carry voting rights. And the other thing to bear in mind is if you're thinking, well, this is a bit like a bond, fixed income, price stable, one thing that differentiates it from a bond is there is no fixed redemption date. Okay, there's sort of an open-ended agreement, or if there is a fixed redemption date, it'll be a long way in the future, 30 or maybe 50 years. So you're buying this thing predominantly for income, and that's something to bear in mind. You're not buying it looking for some kind of big payout like you could possibly get on the redemption of a bond. All right. Now, one final feature is companies issue these things and sometimes think, well, if in 5 years' time the coupon rate looks a bit high, we're being a bit generous basically with our investors, what we'd like to be able to do is pull them back in and issue something cheaper. So very occasionally it's worth reading the small print, or worth asking your broker anyway. You will get what's called a callable preference share. That just means that the company can kind of issue these things with a reasonably decent juicy coupon, but reserves the right to call them back in again, okay, and then issue something that's a bit cheaper should interest rates start falling away, for example. So that's just one little quirk to watch out for. Now, Do I like preference shares? Well, I do quite like them for the stability of the income they provide, all right? But I would always personally do a few checks before diving in, because you are getting something that behaves like a bond, but it doesn't have the priority in the event of a problem that a bondholder would enjoy, for example. All right. So if I was buying a preference share, and I'll give you a couple of suggestions about how you might go about that in a moment, I would probably do one or two checks. Okay, I'll get my sleeves rolled up, do one or two checks first, just to make sure I'm happy with the level of risk I'm taking. First check I would do is the company carrying lots of debt? You don't ideally want to buy preference shares in a company that's already heavily indebted, unless you've got an appetite for risk, okay? Because it does put potentially your dividend payments, even on a preference share, at some risk, because they're going to come behind the coupon payments on those bonds. And should the worst thing happen, if the company go bust, you are running a risk because the bondholders will have to be paid back first. So personally, I'm looking for reasonably comfortable levels of debt before I buy a preference share in a company, okay? Number two, you do want them ideally to be what's called cumulative. I'll put that cumulative. All right, some of them aren't. So you do want the fact that if a company doesn't pay a preference dividend 1 year, and legally they can get away without doing that, your preference dividend entitlement accumulates. So if you want to see it this way, you get 2 the next year. All right, that's sort of worth checking, because otherwise you could, in the small print, actually miss out. I would check, are they callable? Could the company decide that it's issued them at too high a coupon rate and reserve the right to kind of buy them off me in, say, 3 or 5 years' time? It's not the end of the world, but I'd like to know that as an investor. And then, you know, preference shares, no two ways about it, are not as common as ordinary shares. That's one of the problems. Okay, they're just not as common. You don't get as many of them in the market. So they can be quite illiquid. And so I would always check the bid to offer spread on a preference share, because there aren't as many of them around. You might be buying something that's actually quite expensive in liquidity terms. So always worth getting a feel through your broker for what kind of bid to offer spread there is on the preference share you're looking at, okay? One final point, just from a security point of view, kind of links back here, is you could check cover, as it's called. So take a look at the profit figure above the preference dividend line and just see how many times the company can literally cover its preference dividend out of those profits. Now, how do you go about buying preference shares? What do they look like? Where do you get them from? Well, you can buy them company by company. There are not that many brokers around that specialise in Prefs, as they're known, but the likes of a Colin Stewart, for example, you can phone them up and then have a list of preference shares. All right, and as to what you buy, well, you can buy them in individual companies, and at Moneyweek we don't mind doing that sometimes. There are 1 or 2 insurers out there. RSA springs to mind, for example, where there's a reasonable level of yield on the preference shares at a sort of acceptable level of risk, you might say. The other way you can do it is there is an iShares preferred stock exchange traded fund out there that tracks some of the bigger preference dividend paying companies in the market, and I mentioned it earlier on as being a little less volatile than the wider US market. Okay, so preference shares not quite as easy to track down, I'm going to be honest, as ordinary shares, but it can be done, and they can offer you quite a nice secure source of income at a time when, frankly, finding decent income with, you know, cash returns, returns on bank accounts and so on are so low is quite tough. Now, just going to wrap up this video by mentioning my free email service. You can get my videos delivered to your inbox every Thursday free, ahead of them going out on YouTube. All you need to do is pop along to www.moneyweek.com/Tim Trading, all one word. I'll see you next week.